Hello, in this video we will learn about introduction to corporate finance. So let's start. In this session we shall cover meaning and scope of corporate finance, decision areas of a finance manager, objective of maximization of shareholders' wealth, and concept of agency theory. So what are the basic issues of finance? Any business, whether new or existing, big or small, having any structural form, varying in terms of industry, product, service, location, etc., would be dealing with money. Where to raise the funds from, and where to deploy or invest the funds, how much of the profits to be retained, and what portion to be distributed in the form of dividend, whether the funds are being effectively used in the day to day operations, and what is a balance sheet. So, balance sheet has two sides, liability side and asset side. So liability side has shareholder funds, other long-term liabilities, and current liabilities. On the asset side, we have long-term assets, current assets. So how to determine the value of a firm? So this is the formula to determine the value of the firm. So here V is the value of the firm, I is investment decision, F is financing decision, and D is dividend decision, and this is wealth capital management. So what are the objective of corporate finance? To maximize the value of the firm or shareholders' wealth. This would be done through various types of decisions or by a finance manager. These decisions are investment decisions, financing decisions, dividend decisions, and wealth capital management. So investment decisions are allocation of funds in various assets, risk profile of choices made to be considered, investments, decisions reflected on the asset side of the balance sheet. Financing decisions, sources of raising finance, choosing from a wide variety of institutions and markets, internal source of finance or retained earnings, conventional sources of raising finance versus modern sources of raising finance, reflected on the liabilities side of balance sheet. Dividend decisions. Finance manager has to strike a balance between the amount of earnings to be retained and the amount to be paid to shareholders as dividend, reflected on the liabilities side of the balance sheet. Working capital management. So the finance manager shall be ongoingly engaged in looking at how to manage the working capital effectively, striking a balance between liquidity and profitability. Other important areas, risk and return, portfolio theory, and corporate restructuring. Interrelationship between activities. Interrelationship between activities is investment. So the company decides to take on a large number of attractive investment projects. Company will need to raise finance in order to take up projects. If finance is not available from external sources, dividends may be reduced in order to increase internal financing. If company decides to pay higher levels of dividend to its shareholders, then in the finance side, lower level of retained earnings available for investment, meaning that company may have to resort to external sources. In investment side, if finance not available from external sources, the company may have to postpone future investment projects. In finance side, the company finances itself using more expensive sources, resulting in higher cost of capital. In investment side, due to a higher cost of capital, the number of projects attractive for the company decreases. Dividend. The company's ability to pay dividends in the future will be adversely affected. Why value maximization as an objective? What's wrong with profit maximization as an objective? How is value maximization going to be different from profit maximization? So this is corporate and its stakeholders chart. So here we have customers, suppliers, banks, financial institutions, owners and investors, employees or management, researchers, and at last we have government. So stakeholders with varying objectives. Varying objectives are maximization of profits, maximization of market share, maximization of return on investment, beating the competition, minimization of cost, good product quality and service levels. None provide a unfailing framework for financial decision making. Stakeholders with varying objectives. Limitations of different objectives are ignore the viewpoint of other stakeholders, are non-quantifiable, do not account for risk, not based on cash flows, does not account for TBM. The only objective that stands the rigorous test is maximization of shareholders' wealth. And how to maximize the shareholder wealth? A company sells its product service offering, pays to the supplier of raw material, pay wages and salaries to employees and meets all other expenses. So this is the introduction to corporate finance. Thank you.